Welcome back. Roger Montgomery of Montgomery Asset Management has been complaining that he could not see enough value in the stock market. So after this week's market sell-off, is he starting to see some value, or does he see a 40% stock market slump like Dr. Doom Mark Faber? I don't think he will, but still, I'll ask him anyway. Roger, how are you going?
Nice to see you again, Peter.
Are you worried about a 40% sell-off of the stock market?
No, generally not.
Good.
Having said that, though, there is sort of mounting signs that it's worth being cautious. Our process, first sign number one, signal number one, our process is telling us maximum cash. So that means 30% cash in the Montgomery fund, 30 to 40% cash in the Montgomery.
So you got 70% exposure or so to stocks.
Yeah, you're still exposed to businesses.
You're keeping it some powder dry.
The problem, though, is that we're only seeing a few businesses where the prospects are still bright for them. And elsewhere in the market, we're finding that companies are what we call in the industry over-earning. You know, it's as good as it's going to get. The tailwinds aren't going to get better. Banks, for example, you know, they're coming up against a problem now. We saw ANZ's result was good, but the growth mostly came from New Zealand and Asia. Westpac's result, not so good, in fact, quite a bad result. Probably the weakest number they've had since the GFC. And on top of this over-earning, they're now going to see rising capital environment. The NAB's just come out and they said they're going to raise $5.3 billion. What
do you think will happen to their share price as a consequence of that, Roger? Because a lot of people don't understand, but you do. What do you think?
Well, I think long term it's a negative. Well, actually, no, let me correct that. I think in the medium term or short term it might be a negative, but longer term it actually could be a positive because of what they're using the money for. They're basically trying to spin off the UK businesses, which should in time improve the return on equity of the NAB. The reason why the NAB's intrinsic value today is the same as where it was 10 years ago, and it's interesting, if you look at the share price today, it's lower than where it was 10 years ago. And that's because of the drag that the UK businesses have been. Get rid of that, that's a good thing. But what's really interesting is of that 5.3 odd billion that they're going, or 5.5 billion that they're going to raise, $3 odd billion is going to that business to prop up the UK business so they can then spin it off. So it's really, give us your money so we can then give you back shares in this UK business. So, you know, I sort of think that's a bit swings and roundabouts. You know, it's a revolving door of cash. Having said that, though, as I say, long term it could be good. But what they're doing is they're raising capital. The rest of the money will go to what's called CET1 or Common Equity Tier 1 capital. And that's going to put a dampener on their return on assets and or the return on equity rather, because that capital is going to be imposed on them. Now, Mike Smith came out and he said, we're not going to raise until we absolutely have to, until we know what's coming out of the financial system inquiry and whether it's going to be implemented. NAB's gone early. I reckon that tells me, game theory tells me they're the weakest bank. If they want to
the share price has kind of shown it for a long time.
If they want to get the money, they need to go first. In an event that everybody starts raising capital. And I think what they've signalled is all the banks are going to be raising some money.
But also, if you or Thorburn has just taken over, it's a good time to get all the hard stuff out of the way. And as you made the point, that in the medium term, the bank could benefit from it, unloading the UK assets and whatever.
It's a classic CEO strategy, clear the decks, start again.
Yeah, so therefore a long-term investor, if that share price falls as a consequence, a long-term investor may think this is an okay
It might be
play.
Okay. The other problem, of course, is that you've had bond rates, and I'm sure you guests have commented on it already, but you know, over the course of 4 days we saw Australian 10-year bond rates go from 2.23% to 2.9%. That's a big move. You know, it's more than three-quarters of a basis point, three-quarters of a percentage.
Is that a bad thing, Roger? To me it feels like it's more like normality's coming back rather than abnormality.
But what it means is that if investors have been valuing companies using ultra-low discount rates, then the discount rate is now going up. And discount rates, interest rates act like gravity on Earth with respect to asset prices. Stronger gravity,
share price down.
Pull the assets down.
And also, I know some people who calculate fair value on this program, so the cash rate has a role as well. And a lot of those people thought the cash rate was going to 1.5%. And when the Reserve Bank governor said, or implied, no more cuts, well, they would have changed their fair value calculations, wouldn't they?
We don't use, when we're doing fair value calculations, we're holding assets for the long term. So we're basing it off what bond rates are, not cash rates. Yeah. Cash rates could stay where they are. Banks could raise rates because their cost of funds go up. You know, in the bank, the RBA hasn't changed rates. That would have a negative impact on home buyers. I'm sure you saw the stats. If using a median Sydney house price and median income, somebody borrowing to buy a house in Sydney using an 80% LVR, 70%, up to 70% of their disposable income is funding the mortgage for the first year. Now, what happens? That's at present low rates. Imagine rates go up. Yeah. That person's in a bit of trouble.
Yeah. All right. So I'm sick and tired of this negativity. You make me feel sick.
There's value in the market, though.
Good. That's what we want. Right. What is the value?
I think the best opportunity, and you know, look, part of the reason why I'm telling you this is I'm putting my money where my mouth is. Right. Our funds are invested in this company. It's Challenger. Yeah. And we.
Why do you like Challenger? Because it's an annuity business. It's an annuity business.
For a lot of reasons. They have gone first, they've gone early, and they've gone big. And the annuity income business is about longevity risk management. Right? So people buy lifetime annuities. They're buying an income stream for the rest of their lives. If they happen to pass away earlier, the rest of their money stays in the pool, and that's used alongside the company's equity to boost returns for the rest of the investors. Now, the risks, the things that people tell me they're worried about on the existing book, they're worried that there's going to be credit spread widenings and credit defaults. Well, they came through the GFC without any problems. I don't think we're going to see an issue as big as the GFC. And on the new book, people worry that they're not going to be able to match income demands to securities that are available. Yeah. But what they don't realise is that they use their equity as well to boost that income and pass that on to the income.
And rising bond yields is good for them as well, isn't it?
Well, I'm not sure.
Well, they invest in bonds, don't they?
Yeah, they do. But look, the reality is beyond a certain amount of money, you could probably manage a bond portfolio and you could time the maturities and not worry too much about it. Yeah. But you know, for a simple, uncomplicated solution with certain income, without the vicissitudes of the market, you know, they're offering a great product.
Okay,
and they're cheap.
Before you finish, a while back you liked Green Cross, then you didn't like Green Cross.
We sold out.
And the market did very well with Green Cross and the market went off. What's your view on Green Cross now? Because people have been asking me this, you know, what's your view on the company now?
Because the share price has dropped.
And by the way, my local pet shop could not sell its business because the Pet Barn in Double Bay had opened up and the buyer was afraid of Pet Barn. What's your view on the company nowadays?
Look, I think the concept is a good one. Yeah. I think the talent has left the building.
Really?
Yeah.
What talent left the building?
Well, I think the person who founded the vets, gone. Yeah. The person who founded the pet barns, gone.
Really?
And now we've got a CEO running all of the businesses. But I think the talented people have left.
Okay. Well, that's management's always an important part of the judgment call.
Yep.
Roger, thanks for joining us on the show.
It's a pleasure, Peter.
See you in a couple of weeks' time, unless you decide to go on holidays or something.